Every January, millions of retirees open a tax form and find something that surprises them. A chunk of their Social Security check has become taxable income. Not all of it, not none of it, somewhere in between, decided by a formula almost nobody has heard of, called provisional income. If you've ever wondered why your neighbor's Social Security goes untaxed while yours doesn't, even though your benefit checks look about the same, this is the formula that explains it. Here is the plain version. Provisional income is not your Social Security benefit. It's a separate number. The Internal Revenue Service builds specifically to test whether your benefit gets taxed. You build it in 3 steps. Start with your adjusted gross income, not counting Social Security. For most retirees, that's a mix of things like pension income, retirement account withdrawals, wages, and investment income. Next, add any tax-exempt interest you earned, for example, from municipal bonds. Finally, add half of your Social Security benefit for the year. That total, all 3 steps added together, is your provisional income. Some worksheets call it combined income. Same number, different name. Once you have that number, it gets compared against 2 thresholds set by law. Cross the first one, and up to 50% of your Social Security benefit can become taxable. Cross the second, higher one, and up to 85% can become taxable. Below the first threshold, none of it is taxed, and no matter how high your income climbs, nobody pays tax on more than 85% of their Social Security benefit. The thresholds depend on how you file. If you file as a single person, the first threshold is $25,000, and the second is $34,000. If you file jointly with a spouse, the first threshold is $32,000 and the second is $44,000. Now, here is the part that matters most, and it's worth sitting with for a second. Those threshold numbers have never been adjusted for inflation, not once, since the day they were written. The 50% tier was set into law in 1983. The 85% tier was added 10 years later in 1993. Since then, wages have risen enormously, and Social Security benefits have climbed almost every year through cost of living adjustments. For 2026, that adjustment is 2.8%. But the thresholds that decide whether your benefit gets taxed haven't moved at all in more than 3 decades. That mismatch isn't the tax code catching up late, it's the design. Congress indexes ordinary income tax brackets to inflation every year. It never did that for these thresholds. So as benefits and other income rise over time, more retirees cross these same fixed lines every single year, even when their real purchasing power hasn't improved at all. It's one of the most consistent, least discussed ways a retiree's tax bill can creep up without any change in the law. A Social Security Administration analysis projected that around half of all beneficiary families would owe some federal income tax on their benefits. That share was projected to climb toward roughly 56% of families by the year 2050. The reason given was exactly this freeze. Wages and benefits keep moving. The lines that decide who gets taxed do not. Let's walk through an actual example, using the current rules so you can see how the math lands. Picture a married couple filing jointly. Together, their Social Security benefits total $40,000 for the year. They also have $30,000 in other income, from a small pension and some part-time consulting work, with no tax-exempt interest. Half of their Social Security benefit is $20,000. Add that to their $30,000 of other income, and their provisional income comes to $50,000. That's well past their second threshold of $44,000, so both tiers of the formula come into play. Between their first threshold of $32,000 and their second threshold of $44,000 sits a $12,000 band. Every dollar of provisional income inside that band gets taxed at 50%. That comes to $6,000. Above their second threshold, they have another $6,000 of provisional income, and that portion gets taxed at 85%. That comes to $5,100. Add the two pieces together, $6,000 plus $5,100, and their taxable Social Security benefit is $11,100. That is not 85% of their $40,000 benefit. It's about 28% of it. Crossing into the top tier doesn't mean 85% of your whole benefit gets taxed. It means the 50% tier still applies underneath it, and only the slice above the second threshold gets pulled into the higher rate. And that $11,100 isn't taxed at some special Social Security rate. It gets added to their other taxable income and taxed at their ordinary federal income tax rate, whatever bracket that lands them in. Now compare that to a different couple. Same $40,000 Social Security benefit, but only $8,000 in other income. Because Social Security is nearly all they live on. Half their benefit is still $20,000, so their provisional income is $20,000 plus $8,000, which is $28,000. That's below their first threshold of $32,000. None of their benefit is taxable. Same Social Security check as the first couple. $0 of tax on it because the other income around it was so different. That's the whole point of this formula. It was never really a tax on Social Security itself. It's a test built around everything else in your financial picture, with your benefit folded into the middle of it. Whether any of this applies to you and how much of your benefit it touches depends entirely on your own filing status and your other income sources. A retiree living mostly on Social Security, with little else coming in, may land well under the first threshold and owe nothing on their benefit at all. A retiree with a pension, retirement account withdrawals, or part-time income can cross both thresholds even with a fairly modest Social Security check. There's no single right answer here, only your own numbers run through this formula. If you want to see exactly where you stand, the Internal Revenue Service publishes the full worksheet in Publication 915, and it's worth running once a year, especially as your income or your benefit changes. None of this is a reason to claim Social Security earlier or later than you otherwise would. And it isn't a reason to avoid work or pension income either. It's simply a number worth knowing before tax season arrives rather than after. Thank you for watching all the way to the end. If this video gave you something to think about, do one small thing. Subscribe to Retirement Decisions Desk. Every video here unpacks one retirement decision, and subscribing is how you'll never miss the next one. Take care of yourself, and I will see you in the next video.